Okay, time for our fiscal focus segment, as always brought to you by InfoChoice, your choice of information on Australian consumer finance. Now, this week we are talking tax time, given we're in the last 2 weeks of the financial year. So, is there anything we can do to give ourselves the best chance of a big tax refund? Well, let's find out with H&R Block's Director of Tax Communications, Mark Chapman, who hopefully has some tax hacks to share. G'day, Mark. Thanks for joining us on the Savings Tip Jar.
Oh, it's good to be with you.
Thanks for joining us, Mark. So, as to what Dom was saying just then, last year I think was a big shock for a lot of people. They saw a tax bill for the first time. You know, there's a lot of people on TikTok suddenly espousing very libertarian views, saying, "Why am I paying all this tax? Why is there a bill?" So, what can be expected this year?
Look, I think this year's tax returns for most people, assuming that their actual circumstances are exactly the same, will be broadly similar to last year's. The real fuss last year was that the low middle income tax offset ended,
Mm.
and that therefore reduced the size of people's refunds, potentially turned them from a refund to a tax payable case. That won't happen again this year. The LMITO has gone. It's ancient history, so there won't be that transition period this year, and most people can expect to receive, about the same size refund as last year. Alternatively, about the same size payable. But that does indicate that you should be really looking at your deductions to make sure that you can maximise those. Because obviously larger deductions leads to a larger refund. So therefore, you should really be drilling down into those to make sure you're getting everything that you're entitled to.
And Mark, around this time of year, we see lots of retailers, advertising end of financial year sales, or, sort of implying to people that, yeah, boost your tax refund and buy this new computer or tool set. Is there really anything Aussies can do right now to boost their refund, or is that just, marketing?
Oh, well, I mean, those end of financial year offers are potentially interesting. So if you're a small business, for example, you can claim the $20,000 instant asset write-off, which means that you can basically go out and purchase a capital item, such as a laptop or a computer, an item of plant or equipment, tools, for example, and claim an immediate deduction for the cost of doing that, provided the actual cost is less than $20,000 per item. You can basically write off the entire cost straight away. So that is a good way of taking advantage of the tax system. That scheme actually runs for another year, so it's running through until the 30th of June 2025. However, it is worthwhile taking advantage towards the end of this tax year because obviously you can potentially boost your tax return for the current year. Having said that, obviously not everybody can afford to go and blow thousands of dollars on capital items, and not everybody indeed qualifies for the instant asset write-off. So you've got to be a small business. So employees, for example, can't claim it. So it does pay to be slightly wary if you're in those circumstances of those end of financial year offers. Don't forget that even if you are entitled to a tax write-off, you're only going to get your marginal tax rate back, which is potentially up to 45 cents in the dollar. But you've actually got to go and spend a dollar first. Therefore, you're out of pocket by potentially 55 cents. So, you've got to use your common sense. These offers are potentially quite good for people who are in the right situation. So if you do actually need to go and buy a capital item, such as a new laptop, absolutely take advantage, but it probably isn't worthwhile going to do it simply for the sake of spending money to get a tax deduction. That's not really a very sound strategy.
On this instant tax write-off of $20,000, I think during COVID, Mark, it was a lot higher. It was around 150,000. Correct me if I'm wrong.
Oh,
Um,
actually, it was unlimited.
oh, really? Okay.
The sky's the limit. I
Yeah.
mean, every business was entitled to claim every capital item as a deduction, so it's very, very generous. So the version we've got now is far less generous. It only applies to
Yeah.
small businesses, and there is a $20,000 limit, but it is still worth having.
Is it giving sort of tradies carte blanche to buy up the latest ute? Because like I swear, during COVID is when we saw more utes than at any other time in the history of Australia. And now there's big utes like Ram 1500s and whatnot getting about town. Is this kind of distorting the market? I mean, it's not really your place to say, but what's your opinion on that?
Yeah, well, potentially it did distort the market because, if you're able to write off any item of capital expense immediately, you are going to get people who are going out and spending money on these expensive utes, for example, which might well explain why there's so many of them on the roads all of a sudden. Having said that, with the limit coming down to $20,000, that has pretty much put a stop to that because, as I say, you can only claim an item of capital expense costing less than $20,000. So therefore, if you're potentially buying a second-hand ute, you can still potentially claim it if it costs less than $20,000. But these new vehicles are basically off the table now.
I should clarify, this tax write-off is really only just for small business owners, right? Like if a certain employee was to buy a webcam and a microphone for a certain finance podcast, they would they
Dom.
be they wouldn't be able to claim the entire cost in for that financial year, could they?
They wouldn't be able to use that write-off. You're right. That's purely for small businesses
Mm.
with a turnover of less than $10 million. So employees simply can't take advantage of that $20,000 instant asset write-off. Having said that, if the cost of the camera was less than $300, the employee would be able to claim an immediate deduction because there is a separate tax relief which gives up to $300 tax relief for capital items for employees. It's far less generous, obviously, but if you're going out and buying a $50-$100 camera, that is quite a worthwhile addition to the employees. The range of tax deductions that employees could claim.
For sure. And just generally, I feel like every year, there's all this marketing spiel about the ATO's hit list. What is on the ATO's hit list this year? And is that sort of a real thing that they have, or is it just a lot of sort of marketing guff?
Yeah, look, it is a real thing. Of course, the ATO is concerned about the size of the tax gap. So, in the case of individuals, there's an $8.7 billion tax gap. The tax gap is a difference between the amount of tax which the ATO expects individuals to pay and the amount of tax which they actually do pay.
Hmm.
Um, Now, the ATO has analysed this, and they've worked out that most of this shortfall is in relation to work-related expenses, and most of the rest of it is in relation to property claims. So the ATO does look very closely at those two areas. So, if you're potentially looking to overclaim work-related expenses or potentially claim something that you're not entitled to in the first place, then you should possibly stop because the ATO will potentially be taking a look at those claims, particularly in relation to things like working from home expenses, because the method by which people can claim working from home expenses has changed. It changed about just over a year ago. So you're going to have a lot of taxpayers who potentially aren't aware of those new rules, or indeed they potentially choose to flout those new rules. For example, if you claim mobile phone, that there is an element of mobile phone included within the 67 cents per hour fixed rate for working from home expenses, and therefore you can't claim anything else. You can't claim a separate deduction for mobile phones. So the ATO is going to be looking for people who are double dipping. They're claiming the 67 cents per hour fixed rate for working from home, and they're claiming something for the mobile phone. And if they see that, obviously you can expect to get a please explain, and you might potentially have to change to amend your tax return, to take that into account. Also, with regard to the record keeping element, so you've got to now keep a record of all of your working from home hours for the entire year. That's different to the way it used to be. You used to be able to keep a 4-week record and then extrapolate that over the year. So that requirement to keep records for the entire year is a very substantial increase of the compliance requirements. So the ATO is really going to be looking at that. They're going to be asking people to prove that they actually did work a certain number of hours, and they're going to be asking to see copies of timesheets, a diary, etc., for the entire year to make sure that they're entitled to that claim. And if they don't see it, they'll potentially knock the claims out. So they do have a real focus on work-related expenses. Also, property claims, people with rental properties. The ATO reckons that 90% of tax returns with people who own a property contain errors. So they really are keen to drill down into those property claims to make sure that people are claiming only what they're entitled to, and indeed that they're declaring all of the income.
Now, obviously, there's a lot of naughty people out there that probably exaggerate their deductions and overdo it to some extent to try and get the best possible tax refund. But I think on the other hand, there's also a lot of people that don't claim what's rightfully theirs as a deduction. So do you mind just giving us an overview of some of the most overlooked deductions that Australians might be missing out on?
Oh, well, I mean, in terms of deductions, it's important to remember that you can only claim what you can substantiate. The ETO does require substantiation for all of your deductions. So this isn't really a tip in terms of a specific deduction, but there are huge numbers of people who did buy something for work, for example, but they can't prove it. They didn't keep the receipt, they didn't keep the invoice, and therefore they can't claim a deduction. So that does indicate that taxpayers really should be keeping a copy of the receipt or the invoice, the bank or credit card statement, etc., for everything which they think they could possibly claim a tax deduction for. Even if they're not sure, it's worthwhile keeping that substantiation. Check with your accountant when you come to do your tax return, because you're potentially eligible to a claim in relation to that. So make sure that you gather together all of your written evidence. If you can't find a particular piece of written evidence, a receipt or an invoice, go back to the retailer, get a copy of it, because that will make it far easier to claim a tax deduction. In terms of things that people don't claim, well, that really depends on your specific occupation. There are all sorts of weird and wonderful deductions that you can potentially claim if you've got a slightly left field occupation. But in terms of general deductions, do make sure that you do claim for working from home expenses if you do work from home. You can potentially claim up to 67 cents per hour using if you did work from home. As I said just now, you do need to keep a copy of timesheets or a diary or something. So for the entire tax year, and other things. So claiming your car if you're using your car, your motor vehicle, for work-related purposes. Make sure that you claim all of the journeys. Obviously, you can't overclaim, so you can't claim the cost of driving from home to work and back again, the daily commute, if you like. But whenever you're out and about, going to see clients, suppliers, etc., that's potentially a journey that you're able to claim a tax deduction for. You can either claim the 85 cents per hour, 85 cents per kilometer fixed rate, or you can claim actual expenses. And there are lots of other things that you can potentially look to claim. You know, if you buy if you or if you buy or if you bought a handbag, for example, or a briefcase, provided you use that bag for work, you know, you can claim a tax deduction for it. So there are lots of things which you potentially could claim. Some of them are more left field than others, but you know, if you're not certain what you're potentially entitled to claim, do speak to an accountant. They'll be able to give you some directions. They might be able to potentially claim some deductions that you didn't know that you could claim, and you know, therefore, you know, that is potentially an investment which will pay dividends in the future.
For sure. And a bit of a double barrel one here for you, Mark. So I think last year on the pod, you said that you yourself used the flat rate method because it seems like the admin's too high on the actual cost method. And now, you know, now that you need to keep a log of your work from home days all through the year, you can't just have a 4 week representative period. It seems like the admin is even more. Are you still using the flat rate method? And then part two of that question is to what you were saying just there. What's the weirdest sort of thing that you've seen claimed and then successfully claimed back in your days as doing individual tax refunds for people? Because there's all manner of ways to make a buck nowadays. There's Uber Eats, there's, you know, OnlyFans and all these other side hustles and so on. So what's the weirdest sort of thing that you've seen?
Well, in terms of working from home expenses, I am still claiming the 67 cents per hour fixed rate. The compliance requirements, as you say, have gone up. You do have to keep a record of your entire years working from home. That's a bit of a pain. You know, it's not as straightforward as it used to be. Having said that, it's better than the alternative method, which is the actual method. You know, the record keeping requirements with that are very burdensome indeed. You've got to keep record, you've got to keep receipts, invoices for every single expense. And you've also got to do an apportionment exercise. You've got to work out the size of your home office compared to the size of your house. You know, it is terribly burdensome. So therefore, the 67 cents per hour method is still, relatively speaking, favoured in that respect. In terms of unusual tax deductions, well, I mean, as an organisation, we see lots of them. We've got about 700,000 clients. Some of them have relatively unusual occupations. So, you know, we've got, for example, musicians, performers of some description. You know, if you're a musician, you could potentially claim the cost of your musical instruments, for example, or the cost of music lessons. If you're a stage performer, you can potentially claim the cost of stage makeup or wigs. You know, if it's required in order for you to actually perform the part, you can claim a tax deduction. And similarly, you know, if you're in the adult entertainment business, you know, there are all sorts of things which you wouldn't think are claimable for tax, which actually are claimable. You know, toys, lubricants, etc., provided they're used for professional. I was
wondering if we were going to go there.
It's
we went there.
Absolutely, you can claim a deduction for it.
Yeah.
So you know, that just indicates if you've got an unusual profession, you can potentially claim some unusual deductions.
You're a brave man, Mark, going into detail like that about that one. I thought you were going to sidestep the OnlyFans. On a quite a different topic. Obviously, interest rates are much higher than in previous years, so people are paying through the nose on their mortgages and whatnot. So any savings there would be very much welcome. So what I want to know is how prepaying your interest on your mortgage this year, how that could save you.
Well, if you're prepaying an element of your interest on your mortgage, if it's your family home, it won't save you because you can't claim a tax deduction for the interest on your family home. But if it's a rental property, a prepayment is potentially tax deductible this year, and therefore you'll end up with a smaller tax bill. If you're going to do that, it is worthwhile talking to your lender, because obviously if you make a payment off your mortgage, the automatic assumption is that that is a payment of capital, and therefore it is worthwhile having the conversation with your lender to make it clear that the amount that you're actually paying is going to be prepaid interest, so that they account for it properly off the loan. But as I say, provided you do have a rental property, provided it's a rental property that you're paying the interest off, that is a very good strategy for reducing your tax.
There we go. Mark Chapman. We've covered all manner of things on today's podcast, from OnlyFans to the flat rate versus the actual method, and then bringing it back to mortgages, which is our bread and butter here at Savings.com.au. We're just here to help people save $1 or $2. Mark Chapman, thanks so much for joining us on the Savings Tip Jar podcast.
Great pleasure. Thank you.
Thanks, Mark.